Welcome, everyone. Hi, I'm Katie Brooks. I'm the CEO at the Bend Chamber, and I want to thank everybody for joining us today to take a peek at what the economy looks like about a year after the big shutdown. As we see the light at the end of the tunnel, which is a good light, not a train, getting bigger and bigger, and the economy is starting to wake up again, we thought we'd take a look back, see where we are today, and make a note of some of the changes that have happened in just the dynamics of the ecosystem here in Bend and nationally, and also to talk a little bit about the workforce and some indicators on what is happening as we come out of this recovery and back into something that's into whatever the new normal looks like for us. But before we get started, wanted to start off with thanking our sponsors, Miller Lumber, SunWest Builders, and Steel Architecture, Interiors, and Planning. Thank you so much for your generous support. This allows us to bring these webinars to our members and to the community for free of charge. And that's an awesome thing to be able to do, especially living through the year we all just lived through. It's been nice to be able to share this information. And again, thanks to our sponsors for doing that. Alert for an upcoming activity from the Bend Chamber. This is in partnership with with OSU Cascades, Central Oregon Community College, and Opportunity Knox. And East Cascade works to, it's called the Small Business Recovery Partnership. And we're putting on a webinar on, April 21st. And this is geared toward businesses who are trying to recover, who need some expertise in order to get them back on their feet. It could be HR advice, marketing, sales. And in this case, we're doing a webinar on basically accounting and making your financial plan. And this is with Price and Frank. And they are going to be, and also the Business Butlers. This is going to be basically on bookkeeping and accounting for where you are right now, whether or not you took PPP or any other type of federal aid, and getting your books in line not only for the past year, but also to take a look ahead and prepare for what's to come, hopefully in your successful future. These are free of charge. We encourage you to please sign up for that at the Bend Chamber website, bendchamber.org. Okay, so let's get into the program. We've got a lot to talk about. And first up, we want to thank the U.S. Chamber of Commerce for lending us one of their fine economists. Curtis is Dubé, right? Curtis Dubé is going to begin by taking a national perspective on the state of the economy. We're going to discuss where the economy may be heading while walking through a few specific data points, and then talk about the implications for policy developments that you've probably heard all about that are in the mix in Washington, D.C., and share any insights and takes he has on what the economy will look like in the coming year. And so with that, Curtis, I'd like to give you the wheel. Take it away.
Thank you. Thank you so much for having me. I'm really happy to be here with you here today. So as you're saying, I'm going to go through where the economy is right now and where we may be going in the next couple of months. And I have some slides that I share that really kind of drive home the point. But before I do that, I'll just give you a high-level overview of where I think we are. We had a historical contraction in the economy when COVID hit at this time last year. We went into our lockdown in the middle of March, and it lasted into May. It inflicted, as I'll show you, severe economic damage that we've never actually seen before. Historical amount of contraction in the economy and damage done in a really, really short period of time. But we've rebounded in a really incredible way, and there's reasons for that, including the economy was in really pretty good shape before all this began, and that we've had I'm not usually a cheerleader for government policy, but the response from both the Federal Reserve and Congress has been very good and put us in a very strong position to go forward. And right now we're looking at a booming economy for the second half of this year. I don't usually use that terminology very often, but it applies in this instance. We are looking at the end of the pandemic very soon, assuming people continue to get vaccinated. And once that happens, we are going to see the service sector open up in ways we haven't seen in a year. So we're all gonna be able to go to restaurants and bars and travel and all the do all the accommodation and things that we haven't been able to do for a year. And as also you'll see, the American consumer has a tremendous amount of resources to spend on those experiences that they haven't been able to enjoy for the last year. This is a very unique economic period that we've gone through. Usually when you have a severe recession, it happens because of something that occurs inside the economy. Think back to the Great Recession, the financial crisis that spurred the Great Recession. So we had a financial crisis spilled over in the housing market, or the housing market crashed, created the financial crisis. No matter how you look at it, we had a financial crisis. It spilled over into the real economy in 2007 to 2009, and we had a severe recession that went on for a couple of years, and then we had a long period of slow growth. Now that's what an economist would say is an endogenous. It's it happens within the economy. This is entirely different. This is a virus imposing its will on the economy. This is it's coming from the outside. That's what an economist would call an exogenous shock. We don't have these very often, so they're hard to compare. The way an exogenous and an endogenous shock can be very similar is that they cause spillover effects, right? So again, we had the Great Recession caused by the financial crisis. It spilled over in other areas of the economy. That was the big fear here, that we're going to have this virus impose its will, and you'll see in the economic data that the virus really does dictate how the economy's gone for the last year. Once that happens, there'll be spillovers. We'll have a financial crisis that will occur, and that will trigger other areas in the economy. There are bubbles that will be exposed, and those will burst, and we'll have other things that will occur. Well, that didn't happen. And that's the biggest reason why we are in the position we are to grow really rapidly going forward. And so we should be very, very encouraged. And now why that didn't happen, again, back to the three things: strong economy, and good response from the Fed to prevent a financial crisis, and then a good response from Congress that has put a lot of money in people's pockets that they have been spending during the pandemic and have been saving to spend once we finally get past it. So with that, I'm going to share my screen, and I'm going to walk through some slides I have. Hopefully you can see it. You can see the slides now. If somebody could kind of nod at me and say if you're seeing them. Great. Okay. So consumer sentiment matters a great deal, because as consumers feel about the economy, so goes the economy. So if they feel good, they spend more, things are going pretty well. If you can see the bumps in this, so consumer sentiment was at an all-time record high, or roughly a record high, back in February of last year, February of 2020. It falls off a cliff, and it bounces around at a fairly low level throughout the pandemic. Each one of those increases can be tied to periods when the virus had receded, and then each of those declines can be tracked to periods when the virus resurged. Even just the last couple of months, virus levels picked up in January and February, and consumer sentiment fell. March, virus levels have been coming down because vaccinations have been going up. We got the third round of checks that went out. These were the $1,400 checks. Sentiment has increased. Now, I anticipate this will continue to improve as vaccinations continue to go up and economic reopening continues at a larger scale. Consumer sentiment is made up of two factors. It's current sentiment, so what people feel about the economy today, and what they feel it's going to be like 6 months from now. Both those things ticked up in March as well. They had been bouncing around similarly. I was a little surprised because future sentiment had really fallen off in the previous few months, and people just weren't seeing past the end of the pandemic. Now it seems like they are finally starting to get there, which is, again, very good news. The one thing that continues to be very frustrating about where we are is initial unemployment claims. Prior to the pandemic, the all-time record high was 695,000 claims in 1 week back in I think it was 1982 when that recession began. Very severe recession, but it was October of 1982, 695,000 people filed for unemployment. We blew that out of the water. At 1 week in March of last year, we had almost 7 million people file. Now it's come way down, as you can see, but it continues to remain above 700,000. It had dipped below 700,000. It actually dipped below that 695,000 2 weeks ago, but last week it rose back to 700,000. I'm not that surprised that it rose a little bit. It's because Congress again extended extra unemployment benefits from the federal level. I think it's an extra $300 per week. That's an incentive to file unemployment, so that you do see the numbers tick up when that happens. The other thing why I'm not that surprised is that these numbers are totally broken. When you see the weekly jobless claims, the system got so overwhelmed last year, it still hasn't caught up. You have people filing multiple times to get back benefits. You have people trying to commit fraud because of the generous benefits that are available. And this isn't just like my take on it. This is from a story from the New York Times. The absolute number is not representative right now. The trend is what you want to look at, and it remains rather flat. Hopefully, we start to see some acceleration and a decrease of initial claims. What I watch more than initial claims is continuing claims. Continuing claims are those initial claims minus those who are no longer claiming benefits. So hopefully that means they've gone back to work, that they haven't exhausted their benefits. And you can see it's a very steady decline. That number is coming down very, very sharply. And hopefully that accelerates again as you get that opening of those industries. If you heard the K-shaped recovery, there were a lot of industries that took off after the first part of the pandemic and been doing very well. Manufacturing, as we might get into, has done very, very well during the pandemic. It's the service sector, especially restaurants, bars, anything like that, or gatherings that haven't been able to recover. They're at the bottom of the K. As those open up more, we should see unemployment really starting to drop off even more rapidly than it has been. And the job market has been very good. We added almost 1 million jobs last month. This came out on Friday. It was 916,000 jobs, but there were substantial upward revisions to February and January's numbers. So if you look at all of that, there were well over 1 million jobs more in the economy at the end of March than there had been in February. Really good news. The unemployment rate is down to 6%, which is, if you consider what we've gone through, we're in pretty good shape. The issue is, though, we're still 8.4 million fewer jobs in the economy than there were in February of 2020. So we still have a long way to go to get those 8.4 million people back to work. Now, if we add 1 million jobs a month, we'll do it in 9 months, about the end of this year. That would be incredibly fast. I don't anticipate that. Remember, it took from the end of the Great Recession in June of 2009 all the way through February of 2020 to get to the number of jobs we had in the economy back in February, which was 153 million. So it takes a while to grow to that level. So I don't think we're going to get back there anytime soon. But when you see big monthly job gains and you see the unemployment rate coming down, those are great things to look at. Also take a look at this gap because it matters too. It's really like it's the high level, the high watermark we want to get back to say that the labor market has fully recovered. And again, as I was saying, we went through an historic contraction of the economy last year. The economy was doing pretty well. We were in year 11 going into year 12 of the expansion. Again, it had begun in June of 2009. It's the longest economic expansion in post-World War II history. There's no reason to believe that it would have stopped anytime last year other than a once-in-a-lifetime pandemic. We would have continued on growing, but the economy was doing pretty well given that we were at the tail end of a business cycle. We were doing pretty well right up to the end of March when the economy-wide shutdown really kicked in and the data started reflecting that. So you get those 2 weeks of a shutdown, economy falls by 5%. You get a shutdown the 2 weeks in March is in the first quarter. So you get the 5% contraction in the first quarter. You get the shutdown in all of April and most of May, and you get a 32% contraction almost in the second quarter of 2020. That's an all-time record. The previous contraction, very interestingly, was 10% back in 1958 during the flu pandemic that year. So there are some similarities in our economic history to what we went through. I should point out that these are known as annualized numbers. That means that we didn't lose a third of the economy in the second quarter of last year. You have to divide it by 4. It's just how the numbers are presented. Everyone does it this way. It gets confusing when you have historical numbers like this. It's not that confusing in normal times, but you have to really divide it by 4. So you get like 9-10% contraction in the economy just in the second quarter. But you get a huge bounce back in the third quarter last year, over 33%, and then a 4.3% growth in the fourth quarter of last year, and that's very good bounce back. It's encouraging, and it looks like we are on path to grow even faster than that going forward. So the first quarter just wrapped up on was it Thursday or Wednesday last week? So we're now into the second quarter of 21. The first quarter, I actually think it's going to track higher than 5.4%. We're looking probably over 6% growth for the last quarter, and that's going to pick up. That's going to be even higher in the second and third quarter of this year and following and continuing into the fourth quarter and even into 2022. We're looking at very strong growth rates for the foreseeable future because of that reopening and because of the income and savings that I'm going to get into in a second. All that said, it's very interesting. It's important to remember that even with the strong growth we've had since the end of the pandemic, we are just now probably getting back to the size of the economy we had at the end of 2019. That's how big that contraction was. You can see as the bars fall, as we get into the pandemic, the size of the economy shrinks. And then we get good growth rates, but it doesn't get you right back to where you were. It takes a while. It's taken us, I'd say we're probably about back there now. So it took roughly a year, which is really, really fast. If you go back to the Great Recession, it took from the end, so the economy peaked in 2008. We didn't get back to the size, the second quarter of 2008, we didn't get back to the same size that we had prior to the economy, or prior to the Great Recession until the fourth quarter of 2010, so 2.5 years. We did it in a year, in this time. So incredibly, so 2.5 times faster, a very, very rapid rebound. And that's very encouraging. What's also very interesting is that we're going to grow above the trend we were at for the time being. So we would have grown in a certain trajectory had the pandemic never hit. We're going to grow over that. And on the current pace, we're going to actually exceed the size of the economy we had, or match the size we would have had the pandemic never happened, at the end of this year or beginning next year, which is just incredible. So the economy will be the same size it would have been had this never happened. Now we have a lot of growth to make up in the interim when we lost during the recession, but again, very, very rapid recovery. That's been very encouraging. So I'll just hit on two other things before turning over to Damien. Damon. The reason why we are so bullish on the rest of this year is this in the next slide. One is income is now higher than it was prior to the pandemic. That is a very unusual situation. Income usually falls pretty sharply during a recession, and then takes a while for it to recover. Income is only below pre-pandemic levels 1 month since the pandemic began. That was in March of 2020. Every month since then, it's been higher. In some cases, significantly higher. Just last month, after falling sharply in February, so we had the $600 checks that came in January, it spiked. Income was like 12% higher than pre-pandemic levels. It fell because the checks ran out, but it's still 4.3% higher. So a lot of that's government support. That's the checks, the unemployment benefits, some pandemic relief payments to medical providers. But it's also, there's been a lot of people who have remained at work and who continue to earn, and you add all that up, and income's been very, very strong. Now I expect income to shoot up even higher again in March than we had in January, because the checks are more than 2 times bigger than they were sent out in January. So we're going to see another surge in income in March, and then I think things will stabilize for the foreseeable future, because I don't think we're going to see another round of government checks. I can't see how there would be a case for that. Now, a lot of unique things have happened economically and from Washington in the last year, so you don't want to rule anything out. Could happen, but for the time being, I don't think so. So I think we'll see some moderation in income. But so income has been very strong. But the last reason why we're so optimistic about the rest of the year is that people have been spending that. So consumption is roughly right where it was pre-pandemic levels. Retail sales are actually above where they were, and that's with an historic amount of savings accumulating in people's bank accounts. Since March of last year, Americans have saved $3 trillion. $3 trillion. That's a lot of money. It's about $2 trillion more than they would have saved if this hadn't occurred. So there's $2 trillion sitting in bank accounts that Americans are waiting to spend, and that's the money they're going to spend on going to restaurants, bars, traveling, flying, staying in hotels, doing tourist activities. That's where the money's going to come from as we go forward, and that's going to push those consumption and those spending levels up for the remainder of the year. And I'll just point it. So this is consumption. You can see it's back to roughly to pre-pandemic levels. It fell a little bit last month because of the pullback of the government checks. It'll surge again in March, and then we'll see what the moderation is in April and May and going forward. And again, retail sales have been higher than they were pre-pandemic. So that's where we are. Looking 6 months to a year out. I'll stop there. Happy to answer any questions you have during Q&A, and I'll turn things over to Damon. Thank you.
Great. So I'll pass it over to you, Damon. For those of you who don't know Damon, he has been on our webinars periodically to bring us up to speed with what's going on a state and local level. He is a regional economist for the state of Oregon Employment Department. So Damon, what's happening here locally?
Yeah, thanks for having me, Katie, and pleasure to be back here again, speaking with you all. Yeah, let's. That was a great overview from Curtis. Really appreciate hearing the sort of the macro, high-level national trends that we're seeing. And to be honest, our trends here in Central Oregon and Oregon more broadly are relatively consistent with that national. The national trend. The volumes might be a little bit different, but the trend line looks similar. But before we get into the numbers, I thought it would be kind of fun to look over some of my favorite pictures of the pandemic that we've experienced here locally. This one here, many of you who live here in Central Oregon would recognize our old friend Art. And this was from last spring when we still had snow on the ground, and Art wearing his face mask. He was an early adopter of the face mask, and I don't know, I'll never delete this picture. It's just something about it just reminds me of one of our sort of most iconic art pieces in Bend wearing a face mask. Another one of my favorites was this screen grab that I took back in June of 2020. And I don't want you to focus on the blurry Jim Cramer head here. That's not what I'm trying to point out. But instead, if you look in the background, you see that there's the headline there that the Dow's best week since 1938. And the hypocrisy of that headline with what's on the bottom ticker there, where you see breaking news, more than 16 million Americans have lost jobs in 3 weeks. Always a good reminder that the stock market is not the economy. This juxtaposition here was one of my favorite examples of that, sort of the Willy Wonka-ness of the pandemic that we experienced in the last year. And then on a more somber note, this picture from a business that was taken by a fellow economist of mine over in Salem. And they took this after sort of in the midst of the wildfires last fall. And so I think it was a coffee shop. So the sign is closed today due to, this is where nonverbal communication comes in. The put your hands in the air and look around, gestures broadly at everything. Please take care, and we'll be back soon. And it's totally true. Just a lot of our communities were dealt multiple blows, whether that was the wildfires, the pandemic, and just a tumultuous year for us. And just like I said, a few of my favorite images to capture what the last year looked like. But if we're talking about employment numbers, I mean, many of you have heard me talk recently, so I won't go too deep into the initial shock. But we saw pretty significant job losses. Total non-farm employment dropped by over 18% here in Deschutes County. Statewide, the shock was not nearly as significant, closer to just over 14%. Now, it's important to note that the reason why that differential in the shock was more industry composition with Deschutes County and Central Oregon having a higher concentration of employment in the industries that were particularly hard hit. So we have a bigger leisure sector, we have a bigger healthcare sector. We're a health hub for the region. It always still confuses people that we had healthcare losses early on in the middle of the pandemic, but remember that a lot of the non-discretionary more of discretionary health spending, sort of non-essential stuff, sort of dental work. You weren't going to the cleaning or going to your primary care physician for just your everyday appointment. Hospitals were busy. And actually, in some instances, a lot of hospitals weren't busy because a lot of procedures were put on hold. Sort of the a lot of surgeries, et cetera, were delayed. So we saw a lot of healthcare losses there. And then also personal care services falls under one of those industries that was hard hit, which we also have a high concentration of here. So that explains why we had that bigger drop there in April. But I think more importantly is to see that we've had a more robust recovery to this point, and our pace of recovery has outpaced the state as well as the nation so far. And you can see that sort of second wave of the virus, as Curtis had pointed out, that the economic data sort of follows what the trend is with these outbreaks, with the pandemic, in the public health responses to address those outbreaks. The good news was that our most recent county MSA data available through February was sort of our first big jump back up into the recovery mode, where we saw pretty sizable job gains in February for both the state and here in Deschutes County. As Curtis had alluded to, the March numbers are already available, and it was a fantastic month, far exceeding expectations for job growth. I think the expectation here locally is going to be those March numbers are going to look even more robust than they did nationwide for a few reasons. One, we're really going to be capturing even more of the back to school trend that we've seen with school reopenings. And then also in Oregon in particular, we saw between February and March, a lot more counties moving into sort of lower levels of COVID restrictions in that period of time. So the reference week for the March data was one where most counties had moved into the sort of the moderate risk. So anyways, pretty optimistic to see this trend and to know that we're sort of back on that recovery trajectory. And this is just the beginning. And you'll see in a bit here where I'm pretty optimistic that the angle of this graph is going to get a lot steeper here as we move into the next few months. Despite the fact that the employment situation is improving, we still do have a significant number of unemployed people locally in our labor market. The good news is that roughly 73% of those who lost a job due to COVID are back to work. So that's, the vast majority, but we still have over double the number of unemployed that we would have had COVID not been a thing, sitting with roughly 7,000 and just over 3,000 this time last year. So that's a big number. And at the same time, I'm beginning to hear these anecdotes from local businesses, and you might have read it in the paper, anecdotes of businesses finding it increasingly difficult to fill job vacancies right now, which is a head scratcher when you see that there's 7,000 unemployed people in our county alone, and our labor market's even bigger than just the county. However, I will say this isn't completely surprising, as the number who are actively seeking work is much less than that 7,000 figure, and I'll get into a few of those reasons why. So, the majority of people who are unemployed, there's a variety of reasons why you might be unemployed. You could be new to the labor market, so a new entrant. You could be someone who is who actually voluntarily left a job, and then you could also be someone who lost a job loser. And so within job losers, there's sort of three categories. There's someone who completed a temporary job, tends to be a relatively small part of the unemployed, even in recessions. We'll sort of ignore the green line for right now. And then during recessions, we tend to have the biggest chunk of job losers is the permanent job losers, which is the burnt orange line you see here. And then typically a smaller portion is the temporary layoff folks. This was a very unique recession for a lot of reasons, but one of them is the fact that the vast majority of those who lost a job, the job losers, were on this temporary layoff. And also the vast majority of the improvement that we've seen in unemployed are these temporary layoff folks being called back to work. You can actually see that we haven't seen any improvement yet on the permanent job loser side in the state of Oregon. What's something that's important to understand, though, about these temporary job losers is they're very unique in an unemployment sense. So if not all of these people are on unemployment insurance, but let's say that the vast majority of them are. And if you are a person on temporary layoff who is on unemployment insurance, you're a very special type of unemployed person because you don't actively have to seek work. We call it, you're considered employer attached, meaning that you're basically sitting on the sidelines waiting for your employer to call you back because the business has identified you as someone whose job is waiting for when they're ready to call you back. So we can sort of consider that, when we're looking at roughly half the job losers out there today, so half of nearly those 7,000 people are not active job seekers because they remain on temporary layoff, still employer attached, waiting for their employer to call them back. One of the reasons why businesses may be saying it's hard to find applicants, because a lot of the unemployed people aren't actually in the job market looking for looking at job vacancies today. So that's one of the reasons that there might be some difficulty today. Another one is sort of, where is our excess unemployment? So where are the areas where you're going to find laborers with certain skills where there's high levels of unemployment? And if you're looking at sort of the percent change in UI claimants across the state of Oregon, the ones that saw sort of the biggest increase over the last year, no surprises here, where things like food prep and serving, education, personal care services, a lot of sort of the recreational services, a few of the production manufacturing occupations also. So these are sort of the areas where there's excess unemployment. This has been such a targeted recession for job losses that depending on what your business does and who you're trying to hire, there might not be excess unemployment in the skill set of sort of the jobs that you're hiring for. Back in the last recession, the Great Recession, it was a little bit more of an equal opportunity offender. I mean, obviously the construction industry was hit much harder, and same with financial activities. But we saw job losses really across most industries, and it just hasn't been the case here, where especially the professional occupations have had more of a glancing blow, and in some instances actually job gains. So if you're trying to hire a marketing specialist today, you're likely going to have just as much difficulty today finding that person as you would have this time last year. And then another reason why it might be difficult to find workers in today's market is there might still, or we know there are still a lot of individuals who are sitting on the sidelines. If we look at labor force participation rate, and the green line here is the U.S. and the Pacific Census Division, so basically the West Coast is sort of the brownish line there. Sorry, I don't have Oregon or the regional numbers on here, but there's so much volatility in these estimates that it's not worth sharing. But what we know is that labor force participation rate remains, had dropped, rebounded a little bit, but still remains down considerably from where it was pre-pandemic. So definitely people who are not engaging the labor force, once again, meaning that you cannot hire them, they're not available for a business who might have some job vacancies. So who is dropping out of the labor force? I think the obvious, easy answer here, number one, is parents. We know that there's been a lot of working parents who have had to drop out of the labor force because of daycare closures, daycares going to sort of smaller sizes, meaning that they've had to cut some kids out of the daycare facilities, as well as the school closures, or I shouldn't say school closures, the no in-person schooling, so the online school, led many parents out of the labor market. And so as we continue to see schools going back to full in-person here in Oregon, we're going to have full K-12 in person 5 days a week here. Well, I think we're there now here in Central Oregon, but across the state over the next few weeks. Hopefully that sort of creates a bit of a rebound here on the labor force participation rate. Another reason why people dropped out of the labor force and likely are still sitting on the sidelines is those who just don't feel comfortable working in a public-facing job in the midst of a global pandemic. There are people for health reasons, or maybe they don't even have underlying health concerns, just don't feel safe before having a vaccine engaging the labor force. And so once again, this is an area I feel pretty optimistic that as soon as vaccines become more widely available, once again, there's been an announcement from Governor Brown, as well as I think from President Biden, that by April 19th, so in less than 2 weeks now, access will be open to the general public 16 and over. So vaccine availability should really be through the roof here soon, hopefully bring those people back into the labor market. And then the last reason is it's more of a statistical one, but it's theoretically possible that some of the folks on temporary layoff are self-identifying as not being in the labor force because they're not actively seeking work. So that's more of a statistical reason, not an economic one, but could explain some of the drop we've seen there as well. And then finally, I have to address sort of the elephant in the room a little bit, which has been this concern that unemployment insurance benefits are pulling people out of the labor market. Or they're trying to sort of stay on those benefits as long as they can, until they're sort of forced to go back into the labor market. That might be true. I think before we get into some of those details, I think it's worth addressing that the expansion of unemployment insurance benefits was an absolute critical lifeline in the response to this pandemic. That sort of assertiveness and making sure that workers who were basically being told they can't work, making sure that they're whole and making sure household incomes remained relatively stable. People were able to make rent payments, make mortgage payments, et cetera. This was really, really important, and obviously not a long-term fix. We're not going to see UI look like this forever, but for that, the sort of the first responses, it was really important. So that's number one. Now, number two, as we move forward and the economy responds and recovers, these benefits still exist through September. At least now there's a $300 weekly bonus boost to UI. And so it is true, likely, that we are seeing people who are sort of manipulating the system. Fraud is likely a thing that's happening, and people trying to take advantage of the system. If you are minimum UI in the state of Oregon and you get that extra $300 weekly boost, that's the equivalent of around $12 an hour for a 40-hour-a-week worker. $12 an hour, if you're not familiar, is our minimum wage that we have here in Deschutes County. It's slightly lower than the minimum wage in Portland and slightly higher than the minimum wage in our rural communities. So if you're a business who is trying to hire a minimum wage job, then this is your competition to some extent, is UI. Now it becomes less of competition the higher the wage spectrum you're going. But the vast majority of the unemployed folks are on the lower end of the spectrum here as far as wages go. But ultimately, I think we should sort of try to reserve too much judgment for these folks in their individual situations. It sort of isn't fair to assume that there's widespread deception or fraud at this point. Yes, it's probably happening, but is it widespread? Likely not. And as a reminder, 7 in 10 unemployed people are back in the labor market, 70%, actually 73% as of March. So it's not like people are choosing not to go back to work. When they're getting called back, they are going back. One of the reasons why there's perhaps some fraud concerns is the fact that work search requirements have been sidelined for UI over the last few months, and it sounds like those are going to come back online here relatively shortly, and so that should address some of the fraud there. And then ultimately, if this is important for businesses to hear, if you have put people on temporary layoff and or you offer a job to someone who's unemployed, if they turn that down, if they say no, they're not going to come back to work and they'd rather be on their unemployment insurance benefits, they no longer qualify for UI. That is fraud there, and we have a fraud hotline. So just a quick Google search of Oregon Employment Department fraud, you'll get connected with the fraud department there, and yeah, those individuals would lose access to the benefits. It's not sort of a no strings attached benefit. You do need to say yes when you're called back to work. So anyways, we put all this together, and one of the best measures of the labor market more broadly is looking at sort of the share of the number of unemployed people, the supply of labor relative to the demand. The number of help wanted ads is what I like to use for sort of a demand measure. And you can see back before the pandemic, we were hovering around 1 to 1. So there was one unemployed person for every job ad that was out there. Pretty tight labor market. We were at basically full employment back then. You see this ratio skyrockets because of the high unemployment and basically drying up of help wanted ads during the pandemic. But it's already started to come down pretty aggressively. And if we take into account the fact that there's 50% of the job losers are still on temporary layoff and not actively seeking work, that means that the pool of labor that's out there that is actively seeking work is where that little star is right there that I put, which doesn't look that much different than before the pandemic. Meaning that if you are experiencing a hard time filling your job vacancies, you're not crazy. There are some real explanations for why that's the case today. So where are we going from here really quickly? Curtis already hit a lot of the big numbers, why we're optimistic about the direction of the economy, where we're going to be going. The savings numbers are just tremendous, as well as looking at sort of the spending and just pent up demand that we have there. But from a labor market perspective, one of the better leading indicators that we have is these help wanted ads, because a job ad today turns into a job that is counted in payrolls 3 to 6 months from now. And you can see that sort of as we hit fall and into the winter months, Help wanted ads skyrocketed here locally in Central Oregon. The index is far above anything that we've seen. And once again, if you're in an employment hole, you need to sort of see that index go above what it was pre-pandemic to dig out of a hole. And we are far above that level before the pandemic. So I'm very bullish, very optimistic that it's going to be a red hot labor market, job market here in Central Oregon. And, we're only going to hear more of these anecdotes about how difficult it is to fill vacancies as we go forward because of how much competition there's going to be in the hiring market over the next 6 months. And with that, I think I hit my window just in time, right, Katie? I think you're muted, Katie.
Thank you. Everybody gets at least once every webinar to forget to unmute yourself.
Yes.
Penalizing you. So a lot of really great information. Questions are lining up in the Q&A section. And Damon, what you hit on last, I've been hearing over and over from employers about how tough it is, and especially certain industry sectors, to replace the labor force they lost. And there are, as you mentioned, a lot of reasons for that. But let's get to these questions first. Again, just a reminder to everybody, please put your questions in the Q&A section, not the chat. We're not looking at the chat today. And I'm going to start off with a question, I believe for you, Curtis. Are the total jobs added, including those added but not filled? So in other words, are the total jobs you were mentioning, including just the jobs, or do they actually have people who filled them who are actually working in it now? I'm not sure.
Thanks. It's people who have filled them. It's employment. It's not job openings. So job openings is a different series. There's about 7.4 million job openings. I was just looking at it before we got on today, and that number's been rising. So there's definitely more openings in the economy, which is a really good sign. But there's still several million more. I think it's about 2.6 million more people unemployed than there are job openings in the economy. But the improvement in the numbers, that jobs gap chart that I showed you, those are people who have gone back to work. So I think at some point we had lost 23 million jobs in March and April of last year, and now we're down to having lost about 8.4 million. So we've added back about 15 million jobs in a year, which is that's more than a million jobs a month, and that's a really good thing. And shows the resilience of the U.S. economy, that we've bounced back to the degree we have. And once again, we are the envy of the world. We have been have seen the strongest bounce back of any country through this point. So really encouraging.
Great, thank you. This is a tough one. In Sun River and in Bend, again, to the point of a really difficulty finding staff for certain types of jobs, manual labor, housekeeping, restaurant staff, etc. So this is an entry level or lower end of the spectrum type of labor. There are lots of businesses that are looking for staff. And there are Damon, to your point, there are many, many reasons for that. And one of them is childcare. Another one is maybe people are apprehensive about getting COVID because they're not vaccinated. We could go on. They also mentioned the housing crisis. It's very expensive to live in this part of the world. So what is your advice or observation in the availability of labor, especially as we go into peak season here in Bend and the Central Oregon region for tourism? Do you see a lot more folks re-entering, or do you think it'll still be a slow trickle in?
Yeah, so I mean, I'll address the housing piece first. So yes, housing, I didn't address it as one of my sort of 3 or 4 reasons why labor supply is already a conversation we're having. But I guess I didn't address that one because that's always been an issue that we've dealt with here, at least for the last 10 years, well, 5 years in Central Oregon. But before that, we had our own other periods of housing shortage. So yes, housing is a very real constraint and pinch point in our labor supply. And it's concerning. In the last year, housing affordability actually didn't change much because of the drop in the interest rates that we saw. That over 1 point drop in the 30-year fixed rate mortgage sort of eats or counters a 10% increase in home valuation, and so most of that affordability or the prices and increase in home prices was sort of negated by that that sort of borrowing cost. The problem for 2021 is that interest rates are no longer dropping. They're now slowly ticking back up, not aggressively or anything crazy, but home prices continue to rise. So the real estate market is both tight from lack of supply, and affordability is starting to turn the wrong direction again. And we do have just straight up housing shortages even on the rental market as well. It looks a little bit better on the rental market. So a distinct problem. There's no short and fast solution to this. The answer is we need to build housing, build. The good news is that 2020 was the strongest new residential building construction permitting year that we had in Central Oregon since the building boom. So I think like 2006 was the last year we had numbers as strong as we had in 2020. I think we need the numbers even better than they were. However, that's a good start to be moving in that direction. So hopefully we continue to see the trend we saw in 2020 and just keep seeing more and more houses built. But that's a big one for us. Is it's not a short-term fix. It's a long-term one. And our level of population growth has been such that we've sort of been underbuilding for probably 10 years now.
Yeah. Thanks, Damon. So Curtis, back to you. The numbers that you shared on savings, is there a breakdown by income levels? Is this a reflection of more wealthy folks being able to save, or is it beyond that? And it's so the question is, it's hard to imagine that absolutely everybody is in a position to be saving. So what socioeconomic bracket are the folks who are saving the most?
It's a great question, and unfortunately, we don't have the data based on income levels. That would be it'd be hard to drill down on in what is for data is a short amount of time. But the thing to keep in mind is, of course, not everyone's saving. This is always the case with any economic data. You have people who are doing really well during bad economic times. You have two people who are doing very poorly during good economic times. The same applies to a data point like savings. Of course, there are people who aren't saving right now because they're struggling, because they've lost their job, because they've exhausted government benefits. But in an aggregate, we Americans have saved, again, that $3 trillion. And of course, the impulse is often to say, well, it's probably people who are at the higher end of the income scale, but just keep in mind, there's just not that many of them. So for instance, if you say, well, it's probably just the top 10, well, that's just 10% of the population. They just couldn't possibly be saving the $3 trillion by themselves. So it has to be that the savings are broad-based. But that doesn't mean that there aren't people who are struggling and who will still need assistance when we come out of this. But that saving, that huge base of savings that has been built up will be spent in a really large way. It doesn't matter where it is in the income scale, because people have been so desirous of getting to spend on things they haven't been able to spend on. So no matter where it resides, it's gonna result in a strong economic kick at the end of this year.
Curtis, I'm going to stick with you for one more question here before I go back to Damon. So the question in the queue is, should we be concerned about inflation? Something I've also been thinking about, inflation and interest rates.
So inflation is going up and interest rates are going up. That I can say with some certainty. How much? I don't know. That's the question. So should you be concerned about it? It's certainly the biggest downside risk for the economic outlook for the remainder of this year and going forward, that we would get a bout of uncontrolled inflation. What I can say is what we've heard from the Fed. So we did an event with Vice Chair Clarida a few weeks ago. And I asked him, so I said, I'll just use myself as an example. I said to him, I said, I recently turned 40 and I've never lived through a period of sustained high inflation. Are we going to see that for the first time? Because you have huge numbers of people who have never experienced it. And he said, oh no, we have the tools. We know this is potential, and we're gonna make sure that inflation doesn't get out of control. But if you've been following what the Fed's been saying, they want inflation to be 2% on an average and symmetric basis. What that means is that we've been well below 2% for a long time. So they are more than willing to let it run well above 2% for a period of time. So I think we're going to probably get over that probably by the end of this year. We'll see inflation that tick up over 2%, and how high it goes, I don't know. There's certainly the potential that it could take off to levels we haven't seen since the early 80s, late 70s and early 80s. I think that's probably a small risk, but certainly, given that the Fed doubled the size of its balance sheet about this time last year, and it continues to grow it, and then you have this huge fiscal injection from Congress, the potential certainly exists, but they think they have the tools to wring it out. The other thing is interest rates are rising, and you can see the expectations for inflation being built in by consumers. And by the way, this is showing up in all sorts of other economic data. Consumers are seeing it in consumer sentiment data. Businesses are seeing price pressures. That's supply and demand issues with supply chains. So it's hard to get inputs. That's not necessarily inflationary, no, but that's pushing prices up, and it's being conflated with the expectations for inflation coming. Financial markets are anticipating inflation. So there is an expectation that it's coming, and that's pushing interest rates up. But all that said, interest rates are still historically low, and so is inflation. So the question is, relative, yeah, those things are going up. Historically, I don't think it's going to be anything that we haven't seen, but it's just going to be a little bit of a return to what used to be normal.
Right. Fascinating stuff. So Damon, this question is for you. What industries locally here are doing better than in similar periods pre-COVID? So let's think about the 2008, the Great Recession. Our ecosystem here, our economic ecosystem, is much different. So who do you see as the winners in Central Oregon, industry-wise?
Yeah, there's been a few industries that on the aggregate actually added jobs over the last year. Sort of our professional and technical sector grew, which sort of is a terrible catch-all. But think of that as everything from tech to marketing to engineering to law, like all of these sort of jobs that are the ones that had the capacity and the ability to work from home, had very little impact from an employment perspective. And in some instances, like I said, they continue to hire. And the work from home trend is something that we're well familiar with here in Central Oregon, since we've been, one of the work from home capitals of the nation over the last, 15, 20 years. That trend is only going to accelerate, obviously. And I, don't want to get into the future of work stuff, but, do we see that become an increasingly large share of our workforce are folks who work from home or telecommute for businesses outside the area? If that's the case, then we will basically always be undercounting growth there, because they don't get counted in our traditional economic metrics. So as far as industries, it's hard to call a telecommuter who works for some company in San Francisco as a part of any industry, because we don't really know who they work for, but sort of that professional technical sector for sure. Interestingly, construction did relatively well over the last year, but it kind of makes more sense in the context of how good the permitting numbers were. They relatively quickly, the industry figured out how to address some of the health protocol, and we're back to building as quick as they were before. The building side mostly was sustained by the residential building, and commercial dropped off a little bit last year, which also makes sense. And then an interesting trend is sort of, I think Curtis had mentioned that manufacturing did pretty well nationally, and that's true. Here in Central Oregon, on the aggregate, manufacturing has done poorly. That's because we have a high concentration of manufacturing jobs in the brewing sector, and brewing just got devastated. I mean, there was, I just updated the numbers here, but statewide brewing numbers dropped, or employment dropped over 48% in the second quarter of 2020. Just a huge drop there, as they mostly distribute kegs to restaurants or their own pubs, and all those were closed. So even takeout service, most people don't get a pint with their takeout. I think you can now legally. Anyways, so manufacturing looks bad because of that. But if you actually separate out sort of the brewing and look more at sort of our other forms of manufacturing, that actually was a highlight for us here in Central Oregon, particularly with a lot of the manufacturing that goes on up in Redmond. So if I had to highlight three, those would be sort of the three big areas of growth over the last year.
Great. So just a reminder to our viewers today that this will go, this being recorded, it'll be available on our YouTube channel and the Ben Chamber website. So you'll be able to reflect back on all of this later. I have a last question because we only have 6 minutes left. What is the biggest, most useful lesson, Curtis, but both from a government standpoint and also just a private sector standpoint that we take away from a pandemic that was, I forget the word you used, but exo rather than intro? What's your takeaway here of what worked and what didn't?
Sure. Yeah. So it's these are technical economic terms. Don't ever use them. Exogenous means from the outside. Endogenous means inside. So yeah, the takeaway is that to me, the biggest one is that the Federal Reserve really has things down when it comes to fighting off financial crises when something happens, whether it's inside the financial system, in the real economy, or a viral pandemic. So they knew what to do in the beginning of the Great Recession, or the financial crisis in 2007. They knew what they had to do, which is flood the system with liquidity. They didn't know how, and they didn't necessarily have the powers set up to do it, and they muddled through. They got there eventually, but in the interim, lost Lehman Brothers, Bear Stearns, and caused a lot of turmoil. And this is not just about Wall Street. This spilled over into the real economy. A lot of turmoil in the economy because they didn't act fast enough. This time around, they had all the facilities set up that they needed. They hit all the different financial markets that needed to make sure liquidity was there to stop. Basically, it's modern day runs. Just stop modern day runs on all these different financial markets. They had all those mechanisms set up. They hit go instantly. They flooded all those markets with liquidity, and they prevented a financial catastrophe. So to me, the big takeaway on that front is that the Fed really has been exemplary, and that's really good. That's their key role, being a lender of last resort and preventing crisis in the financial sector, and they're very good at that now. On the fiscal side, the takeaway is that you really want capacity to help the real economy when you have a catastrophe like this hit. And right now, I forget the total we've spent in the last year, but it's really, they say $5 trillion, and Biden administration wants to add another 3 onto that in the coming months, and then maybe more at the end of the year. I spent a long time in a previous career talking about the national debt and the problems that will occur from running up so much debt. I think that's probably overblown now. I think we've learned that the U.S. has the capacity to take on a lot more debt, so we can handle what we've taken on in debt. The problem is, if something happens again in the near future, do we have the capacity to do that again? I don't know. That's really it's a human psychology problem about, like, when do financial markets say enough for these guys, we're going to cut them off, and either interest rates will rise. And it could be a ways off, it might not be, but I know we're going to be spending a lot more on Social Security and Medicare as boomers continue to retire. So that is a big concern that, yeah, we have, the U.S. economy is in trouble. The other thing, the U.S. economy is incredibly resilient. We've bounced back in a big way. But my concern is that we don't have the capacity if something happens in the near term, given how much debt we've accumulated during this period before, and then what we're going to continue to accumulate going forward.
Great. Thank you. Damon, in the Central Oregon ground level, biggest lessons learned. What worked, what didn't?
Oh, I've just been so impressed with local response. Whether that's St. Charles and the public health department working together to create this vaccine clinic. Whether that's organizations like the Ben Chamber, EDCO, others that have come together to support businesses. And COVID has done a number of things, but in a world where we've moved with social media and media talking about national narratives and headlines and elections and all this stuff, COVID is very local, right? Like the spread of a virus from one human being to another is hyper local, and the response to that is also hyper local, right? And I've just living through our community, I've just been really proud of the response that I've seen here in Central Oregon, and I'm very optimistic that we are going to get through this, and encouraged by the leaders in our community.
Well, gentlemen, thank you very much. This has been really, really interesting. There's been a bunch of takeaways. I've been taking notes here on the sideline of some of your insights, so I appreciate that. I also want to reach out and say thank you once more to Miller Lumber, Sunwest Builders, and Steel Architect Interiors and Planning, again, for allowing us to bring this content to everybody free of charge, and doing such a great community service. Thanks so much for sharing all of your insights and for being with us today, both to our panel and also to you as the viewer. Thanks so much, and take care, everybody.